Hello, some familiar faces, some faces I don't know, but welcome. Thanks for attending. This presentation is called Trading with Elliott Wave. The first word's important about this presentation, trading with Elliott Wave. I'm not going to go through a bunch of theory. It's not all theory and looking at perfect wave movements because they don't happen in the real market. I've changed my tune a little bit over the last couple of years as it pertains to Elliott Wave. When I was much younger and I was die-hard, counting every little movement and trying to, I guess, fit every movement into a pattern that I thought was going on. It doesn't work that way, and I found out the hard way because I got burnt. So you have to change when you're wrong, and I think I've changed my approach a little bit, and that's what I'm going to go through here in this presentation. Hopefully you can get an idea of how to use concepts in Elliott to help you trade, okay? Help you get better entries, help you identify the trend, and the most important thing, minimize risk. And on the subject of risk, this is a risky market. Trading on margin is very risky, and it's not for everyone. Please only trade with risk capital. That's capital you can afford to lose, that if you lose it, you will not be depressed or go into suicide watch or anything of that nature. First off, the man Elliott himself, okay? We are going to go through, before we get to charts and real-world stuff, I got to talk about Elliott and who this man was. He was actually worked for the U.S. government, but then was bedridden because he was sent to Nigeria to work on a contract there, and caught some crazy disease and was bedridden, so he had nothing to do. They didn't even have TV back then, so all he did was look at charts of the Dow. Okay, the Dow Industrials, the Dow Transports, and he looked at charts ranging from daily, weekly, monthly, and you got to think this guy was really determined because back then you couldn't just pull up a chart on Strategy Trader. He had to plot all the data by hand. And he did find the same recurring patterns, regardless of market, regardless of time. And that led him to develop the theory that became Elliott Wave and bears his name. That theory, he found 13 patterns that recur over time, and they're not necessarily strict in rules as many practitioners make them out to be. They're the same in form, okay, and that is you'll find the same number of waves in order to complete a pattern. Okay, time is less approximate and is not nearly as important as price. Okay, now the big things to take away from Elliott is that the markets are fractal. Okay, and what that means is that you are building like from like. And I'll get to some examples in a second, but think of like a 60-minute chart and the patterns you see on that chart. Okay, they're the building blocks for the next larger pattern on maybe a 300-minute chart. Those are the patterns for the next larger structure, which would be your daily chart, and then your weekly and monthly and so on. So it makes sense logically, right? You're building like from like. And this is just as a tree, comes up as a little branch, right? And then little branches sprout off that branch, and then you have a big tree at the end of the day. You have a big monthly chart, okay? It's the same kind of idea, all right? Now this is the basic pattern. And this is really the most important thing of Elliott. There's really only several rules. I'll get into them in a second. But when you're thinking of Elliott Wave, don't think of all like the little tiny squiggly lines, okay, that are the 5-minute chart that's at the very bottom of your fractal. Think of the larger moves and the rhythm, all right? Elliott gets a bad name, and it's controversial because it's too much is put into one interpretation of wave structure. And a lot of people think it's the Holy Grail, and when they find out it's not, and they get run over by a herd of elephants, which is like what I like to call a big move, or the elephant stampede. They get run over, they get angry. They get angry at Elliott, okay? To me, a good analogy is you think of music, and think of a symphony, okay? The first wave, you have that nice, maybe allegro move, and then the second one's a little quiet, that's the correction, and then you have the big burst in a scherzo. Okay, that's the idea of Elliott. you get in touch with the rhythm of the market, okay, and you're trying to, figure out what the current rhythm is so that you know what's next, okay. You're not composing the music, though. You're not trying to say that this has to happen, okay. You do that and you get in a lot of trouble. So just going through, the basic structure, you have two types of waves. Motive, which is the trend, the larger trend, okay, and then correction, which serves to correct the trend. Okay, now typically we number the motive waves 1 through 5. And the purpose of having 5 waves is to allow for variation, okay. You can just have 2 waves up and down because markets don't move in a linear fashion. Okay, you can't have just 3 up and 1 down either because there are different types of corrective moves. Okay, you have sharp ones, you have shallow ones, and that's another guideline we'll get to later. Typically, if you have a sharp correction in one pattern, in the same pattern later on, you'll have a shallow one, right? And then getting a little more detailed here, a little more granular, right? If you were to look within the waves themselves, you'd get and find that each 1, 3, and 5 wave tends to be an impulse itself. Impulse meaning 5 waves, okay? And each decline in an uptrend is going to be in 3 waves, or corrective. And then when you see action like this, it just serves to reinforce the idea that you're still in that trend, all right? And so bear with me, and these are not real market charts. I understand that. We'll get to them in just a little bit. So this is going back to the euro-dollar 2010. And I like to look at line charts a lot on daily, weeklies, and monthlies because it helps you really isolate the movements, okay, and feel the rhythm of whether or not, you are correcting, you're extending higher, are you still in an impulse, are you still in a corrective move? You remember into 2010 low, we were collapsing. The euro went down to 118.75. You wouldn't see that on this chart because it's just closed chart, so you're just going to get the daily closes. But sure enough, we had a sharp advance, okay? If you were to zoom in on that advance, you can see, I don't have each little number there, but you would see a 5-wave advance. Okay, now at this point, you don't know that the trend has turned. But then later on, as you get this sideways correction, which is slower than the move that was off of the low, you might start to question whether or not that trend's still down. When you break above what was labeled as the end of the first 5-wave advance, you've got a pretty good idea that you're probably going higher after that, okay? So the idea is to pay attention to a 5-wave advance when you see it, especially off of a major low or a major high. Okay, you don't need to zoom in to your 5-minute charts and count every little thing. You just need to understand that maybe the market's dynamics are changing, all right? And you have a sharp move from the low, and then you didn't fully retrace it. So the idea is that another advance of similar proportion and similar form is going to unfold as you go through the top of what was counted as the first 5-wave impulse. Okay, now zooming out a little bit more. That was the first one we saw, right? The 5 up, the 3 down. Then we ended up going higher. Now, looking at this chart, you can see the rally from the June low into the August high. Okay, if you were to zoom in on that chart there, can't you see kind of 2 larger corrections within that area, right? You can count the waves. Just in general, it's a 5-wave movement, right? The point is that the 5-wave movement, 3 of those waves affect the movement of the trend, okay? And 2 of them serve to correct the trend, all right? Notice I'm not getting really into Fibonacci here or anything. I'm just paying attention to form because that's the most important thing. So the implications are, after we saw 5 waves up, we don't know what's going to happen next. You never know 100% certainty, or even you can't really put a probability on it. You don't know what's going to happen. But you have an idea that maybe now we've got 5 waves up, and you would also put your other tools on here, and that is important to understand. Elliott, to me, is just a tool that I use, all right, that is confirming to other indicators like momentum, I'm not going to get a whole lot into RSI here today. Get a lot on RSI tomorrow, but that's used to confirm whether you're in a third wave or a fifth wave. You see divergence after a 5-wave move, then you're probably about to reverse, okay? You see a momentum extreme, say RSI is at 75. Okay, a lot of people want to sell that, right? You might get a day or two of a correction, but that is a confirmation that you're probably in a much larger advance. We'll look at euro-dollar chart in a second. We broke down Friday, 36.50. We got to an oversold level for the first time in quite some time. You know, you might want to fade that trend, but RSI at that low of a level suggests that we're probably in either a third wave or a C wave in the euro-dollar, and that we're going lower rather than reversing. Okay? So the idea after you see something like this, a 5-wave move, is to look lower. And sure enough, we had what would be a 3-wave decline, okay? Now I understand that at this point, looking at these charts is certainly Monday morning quarterbacking, okay, but we have to, in order to go forward, we have to get an idea for what the market trends do look like so that we know what to look for. Okay, now zooming out again, we got the 5 up from the June low to the August high, the 3 down we looked at, and then the implications were for one more big move. Similar in size and similar in form to what we saw from the June low, and sure enough we got that, okay? And again, if you look at the move off of the August low, you can see, again, that is a 5-wave movement in, the fact that you have a first move up, a little correction, then you have the big 3rd wave advance. You remember last fall, that was just the kind of shot straight up in the euro and everything else. And then you had a sideways movement. That's actually a triangle up there, which we'll talk about in a bit. And then you have your final thrust into the final high. And triangles are the most useful pattern, I think, for identifying and forecasting reversals, and I'll tell you why in a little bit. Okay, so there are only 3 rules in Elliott, okay? Only 3 rules, and that is wave 2 never retraces more than all of wave 1. If it did, then you would, by definition, still be in the prior trend, okay? Wave 4 can never retrace all of wave 3, and again, if you did, then you would be just breaking you'd be breaking lows, and you would no longer be in an uptrend by definition. And wave 3 always travels beyond the end of wave 1. And again, all these rules are just to ensure that you make progress in the trend. Okay? It's basically a simplified, I shouldn't say simplified, it's a little more detailed analysis of Dow theory, right? Dow theory says that you move in several big swings, right? Elliott Wave goes a little more detailed, saying that you move in 5-wave movements and gives rules for those to define those movements. But bottom line, the whole point of this is to understand, to define the trend. Okay. Now, as far as rules, this is I find this rule on more of a daily close, or I should say an hourly closing basis. For an impulsive wave, which is the one that you want to ride, that's the one that you want to trade, because those are the fast-moving ones. We've seen a lot lately, okay? The euro-dollar breakout is an example. The Aussie dollar decline from the recent top is an example. Those don't have overlap, right? If you look at a chart and you see a lot of overlapping waves, that's more or less a range type of move, okay? Or for a traditional chartist would be like a diagonal, or sorry, a wedge formation. These moves are the moves that are more like you break out from a pennant, okay, and a flagpole, right, for traditional technicians out there. That is no overlap, okay? That's the requirement for an impulse wave. Okay, now very useful trading application is channeling. And we'll get to some channeling examples here. Channeling, if you put a 1-3 channel line, okay, you can sometimes identify the bottom of the fourth wave by extending that line from the second wave. So what you're doing is drawing, extending out a point into time and looking for an intersection with that level and some former support level if it's a bull market, or a former resistance level if it's a bear market. This is a euro-dollar chart, again, daily chart, and this is from the high near 150, which was in 2009, I believe. 2009 high, it was like 150, 144 if memory serves correct. And again, you get the first sharp drop, a little advance, sharp drop, and then you start getting a rally off of the February low. We don't know if the trend is still down or not. We're just looking for the best entry price, right? We saw, I don't have RSI on this chart, but if I did, you would see a very sharp oversold condition, which again is your clue that you should start to draw a channel if you bounce, because that intersection of the channel and some support resistance that you had in previous is going to identify what could be your fourth wave, high or low. Okay, so that's kind of your trick to an Elliott Wave trade, is after you have a very oversold or overbought condition, look to buy the pullback. Okay, and the way to identify the end of the pullback is a channeling technique like this. Okay. Okay, another example, or I should say guideline in Elliott, is truncation. It's just when you finish a larger pattern, but you fail to go to a new high or low. Again, remember I said it's all about form. Well, say you have a 5-wave rally from a low, but it doesn't reach a new high. At that point, you have to consider maybe that the trend's over and that you're going to get a sharp reversal because the market's weak. It's too weak to get to a new high. Okay, you still have an impulse, but it's too weak to get to a new high. Oftentimes, this occurs once you've gone too far, too fast in the previous trend. Okay, and there's no more buyers left to push it to a new high. And we actually had this in the Australian dollar in August, end of July and August. Okay, the rally from that low, you can see, is a nice 5-wave advance, the circled area. Once seeing that and then seeing a straight move down, you have to consider that we've reversed. You're not going to be stubborn and, again, stand in the way of the elephant stampede and get run over, right, by saying, well, we have to go to a new high. The Elliott Wave theory says so. No, Elliott Wave didn't say you had to do anything. Elliott Wave's telling you that we might have a sharp reversal, actually, because you had a 5-wave rally, didn't get to a new high. Okay? And sure enough, this was actually textbook in the way that we reversed that hard. Okay, this is one of the better techniques, I think, or trading setups that Elliott Wave offers. Okay, is having a truncated fifth, they call it. Okay, a failure. It's kind of harsh to call it a failure, but that's what it is. And the idea is that you couldn't get to the new price extreme, therefore you may collapse, or in the case of a end of a bear market, just skyrocket. Okay. Okay, another reversal pattern, and this would be what more seasoned, traditional, old guard would call just your wedge pattern. Okay, sloppy end of a trend, very choppy. You call it an ending diagonal, and it's not diagonal because it's basically a diagonal triangle, right? It's a triangle, but in a direction. So this is motive in that it's part of the larger trend and it completes the larger trend, but it's not impulse. It's not the sharp movement that you see in the middle of a trend or that we've seen recently, right? This is a very sloppy, choppy, low volume type of trade in the stock market, or just quiet, low volatility environment in currencies or commodities or anything else for that matter. This is the euro dollar at 160. This was the reversal from 160 that we got, which was an ending diagonal. And again, you can see the triangle, but projected in one direction. Okay? And the way to identify the end of these diagonals is you look for what's called a thrust or a throw over out of the top. You connect the line off of your previous resistance, okay, your previous highs. We call it waves 1 and 3. and then when you get a pop-up through there, and then the reversal back down through the bottom of the line that goes off of 2 and 4, you have a trade. You have your reversal trade with a stop above the high, okay? And just like a truncation, these moves are often retraced very quickly and very sharply. And I wish I had examples currently to show you in the current marketplace, but there are none. Because the market's been so volatile, it's not conducive to this type of pattern. Okay, you get this pattern in low vol environments, much like we had, again, this is in 2008, before, you know, the chaos ensued on Wall Street and Lehman and everything else. This was right before. This was the calm before the storm, they say, right? But you can see what happened after. This gives way to a very high volatility environment and very sharp moves. And then, of course, extensions, okay? It's obvious when you look at any chart that you're going to have a very extended part of the trend. Well, this is, you know, what the Elliott Wave we term extensions, okay? Typically in equities, it's going to happen in the middle of a trend, right? You think fundamentally in the middle of a trend is when everything is booming and the best fundamentals and the best earnings and so on and so forth, the best, you know, political environment. A lot of times in commodities and currencies, I find that the extension's at the end of a larger move. And it's usually because the markets are driven by fear, you know, fear of the dollar, fear of inflation, fear of Bernanke printing more money. And an example would be the dollar Swiss, right? The third wave drop we just had into the low with that extreme oversold condition, that would have been an extension. Okay, and yeah, we reversed real sharp, but again, that might just be a fourth wave decline. We've only retraced 38% of the decline from the high that was the extended wave we had in the dollar Swiss. As far as labeling is concerned, it's not necessary to identify the extension, although you'll know which one it is over time. It's just necessary to know that extensions happen and that you're going to be able to count multiple waves. So you might have, you know, a 5-wave movement with one extension is going to be 9 waves, right? Because you have 1, 2, and you have an extension within the third wave, which is going to be a 5 itself, and then 2 more. Okay, so 5 plus 2 and 2 is 9. And if you have 2 extensions, you're going to get 13. Okay, 3 extensions, you'll have 17. Okay, corrections. Corrections are your range trade, your back and forth, what we saw in the euro for the last 4 months until we broke down. Although the jury's still out on what that was. I think it was just a triangle, to be honest with you. But you have sharp ones and you have sideways ones. Okay, sharp would be the dollar Swiss right now, if it is a correction, because that's certainly sharp from the low. Okay, and your flats and your triangles would be your very slow sideways corrections, and the euro comes to mind right now, in which we traded sideways for the last 4 months. The dollar yen right now, the dollar yen might be in a sideways correction, potentially before bursting or thrusting to a new low before we reverse there. In a bull market, you have a 3-wave decline, and usually the two legs are about equal. Okay, so here was an example. This was an example from back in 2010, after we had the move off of the low, right, from earlier. We had a 3-wave decline. Okay, this was that 3-wave decline. Now this illustrates how important form is. I say that all the time, but how important form is rather than the measurements, okay? Because oftentimes you get either a 61-8 relationship between waves A and C, or a 100% relationship as we look at the dollar Swiss right now, for example. But in this case, you didn't even reach the 61.8. So after you saw this decline and you started to see a reversal, okay, you probably wouldn't know for at least a month or so, but after you saw the acceleration, upside, knowing that the larger rally from the low is in 5 waves, you're not going to stick to your bearish interpretation and say that, oh, we have to reach 2550 because it's a Fibonacci extension. Okay, it doesn't matter. The form is there. You already did 3 waves. Okay, so don't allow the extensions or your need, like my old need, to fit the data into a perfect time and price intersection, distort your view of the market and what's really going on. Okay, so a flat, it's just that, right? It's more of just a rectangular shape, typical range, okay? A lot of times these are very diabolical to the patterns and destroy many a trader, because your first decline will be fully retraced and you'll kind of nick the high, right? And then you'll come back and you'll collapse and take out the low, and then it'll reverse and go the other direction, right? This is a very deceptive pattern, and one that gets a lot of people in trouble because it's a lot of false breakouts. This would be, I would call this the false breakout pattern. Here's an example. Euro dollar. This was one day. This is July 2010 rally. 5 up, 3 down. This is a better example here. Euro dollar 300-minute chart. And you can see what I mean by the false breakout on the downside. As we come down, we don't even quite reach the 100% extension, and then it just quickly reverses. Okay, a lot of times you would think that this would be a larger breakdown. Okay, triangles. These are the best. I think these are the best patterns out there for trading, because they tell you two things. One, you get the ability to play a breakout, and two, you get the ability to play a reversal off of the breakout. Triangles are terminal patterns, meaning that they occur as the last pattern before the final move in the trend. You can have the rare expanding triangle, but that's impossible to trade, so it's not even worth really talking about. A couple examples of triangles on the euro-dollar daily chart. Those are both triangles, okay? You might not be able to tell at the moment. We'll zoom in a second. Those are both triangles, okay? The first one, first of all, triangles never going to look, very rarely, do they look like perfect triangles. That's just not realistic, okay? This is what a triangle would look like if you were drawing it on a piece of paper. It never looks like that, okay? They're usually disguised, much like everything in trading. Okay, it's a game and it's deception. It's trying to fool you, right? And so you got to understand that. Zooming in, this is the triangle, the first one. Okay, that's the first triangle. Looks a little more like a triangle there, right? Basically, all you have to know is that a triangle is characterized by a sideways contracting volatility environment, and that when you get that final break to the upside, it's just that, usually a final break. Okay. And that you're going to get a reversal. Now, there's also a trick to anticipating the level at which you may get a reversal, and I will show you with the dollar Swiss chart in a second. Here's the second one. This is more of what a triangle really looks like, and more likely to find in real life, because it doesn't even hardly look like a triangle. It's going to be breaking a lot of highs and lows, and at the end you'll contract, and that'll tell you it's a triangle. You're never going to know that you're in a triangle until it's over. Okay, so it's kind of difficult to trade during a triangle because it's just a very sideways, sloppy environment. The value of knowing it's a triangle is after you break, and you can identify it, and it comes with just looking at charts over years and years and years, and you know when you're in a triangle after it's over, and when you have the final break, you say, oh, you know what, I think that's a break from a triangle. Don't get caught. It's a bull trap, probably going to reverse. Okay. Also in this chart, notice the channeling as well, with the 1-3 line, and then the 2-4 pretty much identified the low to the very accurate degree. Okay, tricks with RSI. This is the best way to objectively understand where you are in the wave structure. Okay, momentum extremes indicate third waves. I always use RSI. For my, some people might prefer rate of change. If you do, then you can apply the same rules here, okay? But basically, momentum extremes indicate third waves. So if you see an overbought level of 75, 80, whatever it is, or an oversold level of 20 or 25, then you're probably in the third wave, which tells you a lot, because you understand then that you're probably going to get a fourth wave, a sideways correction of some sort, a partial retracement, and then that's when you draw your channel line. Okay, and you have an idea of where you can re-enter to catch the end of that trend. Notice that a lot of these patterns for Elliott work best at identifying where you may find the last move and where you may reverse. It's a lot like driving across the country, okay? If you're in a car, you know exactly where you're starting from if you're starting in Maine, okay? And you know exactly where you're ending in California. But in the middle, you could go all over the place, okay? You could go up through Illinois or wherever, or St. Louis, where I'm from, or you could drive down through Texas, and you could go all over the place. So the middle part is difficult. It's once you get to the ends is where the Elliott wave theory comes in to play. You see the triangle, you understand that we're probably nearing the end of a trend because we're going to pop higher in the final move, okay? The channel, okay, we were hitting the channel, we had a momentum extreme, so we're probably going to go test the low, make one more low before we reverse, okay? So these are examples, and this really complements Elliott, and they both complement each other very well, because when you're in a downtrend, I've talked with a lot of you about this the last 2 days over at the booth, but when you're in a downtrend, you're never going to get an overbought position, you're never going to get RSI at 70, and sometimes not even at 60, okay? Usually you're going to reverse at the midpoint at 50 or close to 40 or maybe even lower. So you can see this entire downtrend and what happens. RSI is reversing at 40. So the people that are waiting to get out of their losing short or long position for RSI to get overbought or waiting to short are never going to get the opportunity, okay? So I like to say RSI doesn't necessarily just range between 80 and 20 or 70 and 30. In a bull market, you're going to range between 80 and 40 or 50 even. And in a bear market, you're going to range between 20 and 50 and sometimes 60. So that's the best way to understand if you're at a relatively high price or a relatively low price as far as the recent history of price is concerned. Okay, so reviewing a little bit, markets are fractal, right? The patterns that you see on the short-term charts are build up to the longer-term charts, 5-minute to hourly to 300-minute to daily, okay, and so on. The basic 5-3 pattern is the basis for all of Elliott. Two kinds of moves will affect the movement of the larger trend. The impulse, which is your sharp advance or sharp decline, and diagonal, which is your, your sideways triangle, or I should say diagonal triangle, where you're sloshing back and forth seamlessly, aimlessly, but within a trend. And then corrections, zigzags, flats, and the most useful are triangles because they tell us so much about where we are, within the larger trend, right? Typically at the end of a trend, you will break from the triangle and then you will reverse. And don't forget the measuring technique that can be used, and that is the first leg of the triangle, take that difference and extend it from the breakout level, okay? And it often gives a target for the final move as well as a potential reversal, and reversals are nearly impossible to trade, right? There's psychological reasons for that because it feels like the most difficult time to put the trade on, but this gives us rules and points of reference at which you have a better idea or a better probability of maybe catching that move, okay? So you just take the concepts, the important concepts, in order to understand where you are and understand the rhythm of the market so that you can dance to the next tune. You're not composing the music, okay? You're listening to it and you're trying to follow it. So that's all I've got for today, and I'd love to take questions. It's been, I guess, I don't know if anyone has this room next or not, but I can take questions here or we can go back to the booth, whatever you guys want to do. So thanks for coming.